started. It's a little after 7. My name's Bill Kearney. Thanks for being here tonight, especially with the topic of purchasing a timeshare in Central America. I know that's on everybody's mind, so if we'll go ahead and lock the doors and get your checkbooks out, we can get started. Not what you're here for, is it? No. Well, we'll talk about the tax code in just a few minutes. I thought I would set up the class and just tell you a little bit about what we're going to do and what you have in front of you. Most of the information is pretty much self-explanatory, but the interesting thing about this class is part of the class is in the light and the other part is in the darkness. The first part of what we have to do, we need to use our boards over here and an activity we have to do in front of you. And then it's a little difficult to see the screen, so what we usually do is turn the lights down. So we'll prepare you before we shock you by turning the lights off on there as well. So you've probably been through the information in your folder here a little bit. First of all, I'll tell you the class is just information in nature. I'm not selling anything or anything like that. So just relax, gather everything you can information-wise. I like to be up front and just let you know our disclaimer on what we do is right here for you. We're just letting you know this is for informational purposes. I'm not giving anybody specific financial advice. However, if you learn something tonight that works well in your particular situation and you want to tell everyone else about it, we'd be happy to take credit for that. Otherwise, we never met you. The other things that are in here we'll go through as well. And there's a couple of things. You know, what usually happens out of this class is people like to come in and maybe have a little bit more personal conversation in a consultation. And sometimes people don't know what that means, and they don't know if they really should do that or if they need to do that. So in your packet, you'll see a document that says, "Do I need a consultation?" And it's a little quiz that you can take, and as you score yourself, you might determine whether or not you fit into that group of folks in there as well. The other thing is there is a taxes and retirement quiz in here from what you learned tonight, and after the class I'll send out a message with the results or the answers to this so you can see how much you learned here as well. The other thing I was going to tell you too is if you have questions, and you probably will, I would suggest that you write them down somewhere in the packet, record what your questions are. Otherwise, we're going to have to call in Dunkin' Donuts and they'll serve us breakfast because we'll be here for a while. I want to make sure I get you in and out of here in a reasonable amount of time. Okay, is that fair for everybody? Okay. Before I ever go into a class and I jump into a specific topic, and our topic tonight really is about the changes in the tax code and how they affect investments, I want you to know a little bit about the lens that I use or that I look through when I talk about any of these topics. This tax planning is a small part of what I would consider a very large puzzle. And in retirement income planning, one of the big tools that we use is Social Security. We look a lot towards Social Security. It also comes into play in the tax code now and some of the changes that have occurred. And we're going to talk about that. But just because of my age, I'm in my early 40s, I look at Social Security a little bit differently than maybe you do. Social Security is something that over the course of your life, we put a lot of our money into, a lot of assets into. And so I consider it just that. It's an asset that we're looking towards to use for income purposes in retirement. And for everybody in the room, it's going to be a little bit different. How much you actually receive, how much I receive is going to look different than maybe what it looks like right now. But I just consider it a tool, if you will, in a much larger jigsaw puzzle that makes up retirement planning. So Social Security is a tool that we would use. So I want some participation if you guys would on this. What are some other tools that we have access to in America today where we can put our money? And you can see the little chart if you want to follow along and fill this in, you can. An IRA?
401k.
Well, those are actual types of plans. What are types of investments that we can put our money into? Stock market, right? Like mutual funds and stocks and all that. Okay, so stocks, CDs,
bank accounts, mortgages, rentals,
real estate, right? What else? Annuities? What about bonds?
Yeah, you don't wanna earn anything.
Nobody wants bonds anymore.
Okay. Any other tools that we can invest in? That's a pretty good list, right? So these are all the tools, or pretty much a good list of the tools that we can invest in. Now, let's talk about a couple of these for just a minute. Like, for example, CDs. So right now in America, there's about $10 trillion in CDs. Or in the banks, and a lot of it is in CDs, let's put it that way. Why would we put money in CDs? What are CDs paying now, 5, 6%?
Maybe. Maybe.
If you like it.
Yeah, more like 0.5%?
Yeah.
Yeah.
Why, so if there's $10 trillion in something that's not paying a whole lot, why are we doing that? It's what?
safer.
So maybe a result from these tools that we're looking for is some safety? Right? What's another reason you put money in the bank?
FDIC
Protection,
protection.
safety. Also, most things in the bank are what? Accessible?
Oh, yeah. CDs are not
So-
though.
CDs aren't, but most everything else, your savings and checking is, right?
Yeah.
All right.
They're putting in.
What about municipal bonds, for example? Let's use that as an example. What would you use? Why would a municipal bond be a good investment?
I don't think it would be. But
There's one thing in particular it does. The income you receive from it is
tax.
tax-free. So you can get some tax-free income. What about mutual funds? Why would you put money in mutual funds? What are you trying to do there? If you invest in the market, what are you trying to do?
You're trying to diversify and make it work for you.
Right?
Get a return.
A return, right?
Return, yeah, that's what
Growth.
I'm saying. Growth.
Okay, annuities. What is a simple definition for what an annuity does? An annuity
Pays you all the
contract,
time.
annuity contract provides you with a stream of
Income.
income. So for example, if you put $100,000 into an annuity, you leave it in there for a few years, and then you call the company and you say, I want you to turn on that stream of income you were telling me about, they'll do that. Now, if you start receiving that income and it comes in regularly, monthly, year after year, decade after decade, eventually you're going to deplete all the money inside that annuity, right? So what happens when the money inside the annuity that you've been receiving income on, what happens when it runs out of money?
What happens to the annuity?
Yeah, what happens when it runs out of money?
It's gone.
The income's gone, right? Well, actually, did you know that with annuities, the actual contract can run out of money, but it can never run out of income? Say that again. Inside of a contract like this, you can run out of money, but you can never run out of income.
So where is the income coming from then?
Well, that's part of the way the contracts are structured. Okay? Now, so those are some results that you're looking for here. And what are all these things? If you put a little bit of money here, you put a little bit of money here, you put some here, you put some in bonds, what are you trying to do with your money? You said the word a little earlier.
Diversify.
Diversify. Okay. Now, let's talk about life. What's important to you right now when you think about your life? What are the things that are important to you with your life?
Living comfortably, having vacations.
Having no debt. Travel, upgrade.
What else?
Health, of course.
Health. It's a good one. Maybe faith?
Yep, very good.
I promise, we're going somewhere, you'll see this in a second. What else is really important to you? Anybody have kids
Yes,
or grandkids?
family.
Now,
Not outliving your own career perfection again, I guess.
now looking at these three columns, if I had to ask you which of the three is most important to you, which is it?
It's life.
Of course.
It's this over here, right? You know, every time I've done this, I've never gotten a different answer. I've never, ever in my office, ever had somebody say, hey, Bill, you know, nah, it's not life, it's that mutual fund I have. That's the most important thing to me. But think about it this way. With these two columns over here, we pour millions of dollars into these over our lives. People do, right? And the average person works 90,000 hours before they get to a retirement age. What are they doing? They're working 90,000 hours to fill all of this up. Why are they filling all of this up? So that they can take it and transfer it over here to have a life when they get to retirement. Right? So, what happens if at any point this goes away? How much does this matter if you don't have this?
Doesn't.
You know, the other thing I notice is that when there's a problem here, people tend to find this pretty quickly, right?
Yeah.
The reason I say that is this is the lens through which I look through it. I know what's important, I think, to people is this over here. And I want to tell you that sadly, I think our industry spends way too much time over here. Does that make sense?
Yeah.
If you can define what these are, and a little caveat to this is when we do this in the office, we change life to goals, and I'll explain why later, and we change results to strategy. And I'll explain why we do both of those things later. But it's important because all of these little concepts that we talk about are all framed around this right here. It's all framed around that. That's what matters. That's why you're doing it. That's why you come out in the cold weather to hear somebody talk for an hour about this sort of stuff, right? Okay. So with that little introduction, we'll talk about our tax code. And by the way, this is what the first slide is in the presentation. You guys agree with this?
Yeah.
Ultimately, if you can't replace the income you're receiving while you're working, you cannot retire. All right. Now, the next thing we're going to do is a little activity. Inside your packet, there is a chart. Somewhere in here. This. Looks like this. It's got a whole bunch of numbers on it. We printed it out because they're really small and really hard to see. And I wanted you to know we're not lying. We're going to tell you what all those little numbers mean. It looks just like this.
Yeah.
There you go. Okay. So the question is, how does saving $155,000 of tax lead to paying tax on over $1 million? Well, first I have to ask you, does everybody understand when I say qualified plan, what a qualified plan is? Somebody mentioned a few of them earlier, but what is a qualified plan?
401k. IRA.
Qualified plan, simple definition is, it is a tax qualified plan that is qualified by the IRS for certain treatment. Okay, so 401k, for example, receives tax treatment, and the relationship is you put money in, you get a tax deduction when you put money in, and the deal is when you take the money out later, you're going to get taxed on what you take out. Okay? So I'm going to give you an example of how that works for people. What you have in front of you is an example of somebody who's putting away $5,000 a year into a 401k, for example. This person does it from age 35 to 65. So that's 31 years. So if you want to check my math, 5,000 times 31 years is $155,000. I'm pretty sure we got that right. All the rest of the numbers, I don't know. $155,000. So when he put the $5,000 in, He deferred paying tax on that money each year and then invested it. That's what we do when we put it in the 401k, right?
And you got 7%.
Got good growth on it. So over that time, the 5,000, the 155,000 grew to $528,000. So now we hit retirement, we've got $528,000 in the account. Now the deal was, you get the tax deduction on the front end, but when you pull the money out, you gotta pay tax on it, right? So he hits retirement age 66 and he starts pulling money out. Actually, age 70 is when he really starts pulling money out of the account. 23,000 a year, just this is required minimum distribution age.
70.5.
Over the next 15 years, 16 years, he pulls out $529,000. But remember, the account is still growing at 5% per year. So he passes away at age 85, there's still $632,000 in the account that he's going to pass on to somebody else. So he put away $155,000 and said, I'm not going to pay tax on what I originally put in the account. Pulls out $529,000, pays tax on that. Then passes on $632,000, which is over $1 million that someone, either he or someone else, is going to pay in tax on this account. So what you're looking at is a classic example of pay me now or pay me later. And there are very few examples where pay me later works out well. This is one of them where it doesn't. I don't care, time value money notwithstanding, this is a good deal for the IRS. Really good deal for the IRS, okay? So you might look at this and say, well, wait a minute, I'm a little bit closer to being down here, having earned or having saved up $200,000, $300,000, $500,000, whatever it is. How does this help me? Well, there's two ways this helps you. Number one, first of all, if you have kids, and they're putting money into plans like this, and they're not receiving a company match, you need to tell them stop. Because anything above the company match is setting up this relationship. And we've already looked at this and said if we had the choice, we probably want to pay tax on $155,000 versus $1 million, right?
Yeah.
Would you want to pay tax on $528,000 versus $1 million?
Yeah.
It's still a better deal, isn't it?
Yeah.
So even if you're at this point, right at the age of retirement, or somewhere in between, it's never too late to make this work. And that's part of what we're going to talk about tonight. All right? So that's an example of how these plans work and kind of the deal that you set up when you start out with them. Oops. My clicker went to sleep. Okay. So what we really see a lot is that qualified plans lead to a lot of tax problems during retirement. And the Trump tax code, and we're calling it the Trump tax code, like them or not, that's not what we're talking about tonight. We're just delineating that this came into play last year, and it created some interesting changes that are helping people. And it's for a limited period of time. The actual code sunsets in 2026. So we want to make sure people are aware of what's going on. We see, in this case, a large percentage of people who are either retiring, going to be retiring soon, who are making some pretty big mistakes in what they're going to do when they're planning for retirement. So I wanted to share that with you guys so you don't make those mistakes. All right, so let me go over some of the problems with the IRAs, 401ks. First of all, every distribution that this person takes out and anybody takes out is taxed at your highest possible rate. So when you do your taxes each year, you might end up with an effective tax rate of 15%. You may actually be in the 24% tax bracket because of your income. But effectively, with all of your deductions, you might be down into the 15%. When you take a distribution from these accounts, it's taxed at the 24% rate. There is no effective reduction down in what you have to pay in tax.
So you mean when you retire, you're taxed at the...
Whatever your highest marginal rate is, there's no way to deduct that down, if you
So
will.
over your lifetime, is that what you're saying?
Correct.
All right. I understand.
Distributions might put you into a higher tax bracket. So when you get to 70 and a half, what happens? What's something that the IRS makes you do?
Pull out your money.
What's that called?
Distribution.
That's part of it. There's two other words in there. Required minimum distribution. So you hit 70.5, and if you don't need the money, let's pretend, are you a stubborn person?
Yeah.
Stubborn? Let's play this out.
Yeah.
So let's pretend that you're 70.5. You don't look anywhere close to being 70.5. But let's just pretend that you are. The IRS comes to you and says, I need you to take out $25,000 from that account. And you don't need the money. So you say, I'm not going to take the money out of the account. I don't need it. What are they going to do to me? So if you do that, what's going to happen? That's right. You're going to pay. You know what the penalty is?
10%.
Well, that'd be nice.
How much is it?
50% penalty. So if you're supposed to take out $25,000, you have to pay a $12,500 penalty, and you have to pay tax on the full distribution.
Land of the free and home of the brave. Huh?
That's about a 75% penalty if you don't do it. All right. And by the way, these are the only accounts in the tax code that require you to take money out of them, whether you want them or not. It's the only account that does that.
Is that 25% per year?
It's not set. It's set on what your tax rate is. I'm just using that as an example. Okay, so it's based on what your tax rate is, and there is a required distribution table.
Okay, so it depends on how much you make?
Correct. Well, there's a table that's applied to your account, your balance, your total balance, and they'll say this is the percent you need to take out each year when you hit that age. All right. Distributions also lead to what I call a double tax. Not only do you pay tax when you pull the money out in a distribution, but it can also lead to higher taxes on your Social Security income. The government has set up what are called provisional rates. Tracy, would you mind closing that door just for a minute while this class is changing? Distributions can also lead to more taxes on capital gains. Again, only account that requires distributions if you don't want or need the money. And this is the highest tax account to leave to your beneficiaries. So all around, in retirement, these are a mess. It's a good deal on the front end because annually you're saving money, but what you're doing is building up a burden on the back end that can be very hard to unwind.
Especially if you keep working.
Correct.
Because you're going to have a higher tax bracket.
Correct. I'll tell you that there's very few people that I've worked with in income planning that actually end up in a lower bracket. A very small percentage of people that end up in a lower bracket. There are very few people that want to take a pay cut when they get to retirement. Okay, they get used to a certain standard of living. So the result is that these accounts can often lead to more in tax than you ever planned on. And really during the retirement years, you can easily argue these are the least tax efficient accounts that you own. This has become a whole sub-segment of the way we plan in our business is how to deal with unwinding these accounts. So how does the new tax code help? So, I meant to bring them with me. I don't think in your packet there are ones for single filers. There is one for, we're going to do the example for the filing jointly one. This is the one for single filers, but just follow along because you'll get the concept here. If you pull this out here, you'll see the numbers a little bit better for you. Where it says current law, by the way, that really needs to be changed. That's the old law. The final plan is what we're in right now with the new trunk tax code, okay? So current, if you want to cross through it, the current one is actually the old law. This is what it used to be, and I just wanted to highlight for you. And I think we're probably ready. We can turn. Would you guys be able to see a little better if I turn the lights down?
Yeah.
Turn them off?
I can do it.
A Roth, isn't Roth considered a qualified plan?
It is.
But it's not considered, it's not one of the ones that's problematic.
It's a big star in our show tonight.
Okay.
It is a big star in our show tonight. Yeah. Yeah, no, that's a good question. It's definitely part of what we look at now. Can you guys see okay with this? I know it's a little dark in here, but the lighting is not ideal for the projector. Okay, so if you look here at the tax rates under the old law, you'll see this area right here is where we saw really significant change between the 25% bracket and the 28% bracket. They actually reduced them down to 22 and 24%. So right here, if your eyes come over here to this side, see that says 315,000? You really, with the standard deduction now of 24,000, you can draw out $339,000 a year and still be taxed at less than 25% on that money. Now, I've looked through the history, this is the only time that I can find where you can draw that amount of money, that large amount of money, for less than 25%. All right, so this is a big part. Walter, you brought up the Roth. This is where that leads to. It's giving people an opportunity to consider shifting away from where they are.
So that final plan is what we're in now.
This
and
one
then-
right here.
And now we're gonna be switched to the Trump tax code?
This is the Trump tax code here.
Okay.
And this is where it was. Look, before, to get to 339,000, you'd be in the 33% bracket down in here if you tried to draw the same amount out before the law was enacted. So I thought, you know, this is a pretty good opportunity for people that may be in these qualified plans to potentially look at unwinding them. And even folks who are still working now, we work on longer term plans on how to wind these down a little bit during their working years.
Why didn't you say draw them out? Draw
Withdraw.
out that
Withdraw?
amount.
I'm not following
You
your question.
said draw out 339,000. That's your taxable
Correct. This-
income.
You can report, let's say you can have 339,000 in income, which can include a distribution from an IRA or 401k or whatever. You can have up to that amount and still be in the 24% bracket.
So is that where you were getting, but is that the 24% that you were talking about as being the taxable rate on it before? Or is there a separate, you implied that there was a higher tax rate on your,
No, in other
on your
words-
minimum distribution?
See, Walter, you and I could draw out 300,000, and with our other deductions, it might make our effective tax rate on other income, say 20%. But if any portion of that we pull out of that 300,000 is from an IRA, a pre-tax account,
Okay.
it's going to be taxed at 24%.
Because that's the
That's
highest
the
marginal
highest it
rate.
can be in that bracket.
That's the highest marginal rate.
Correct.
Okay.
There's no way to marginalize that down, if you will.
But your $339,000 assumption is that you have no other income.
Correct. So you could have
Okay.
75,000, less 339 could be what your distribution is.
Okay.
And actually, it's a little more complex than that. We're going to look at it, and I'll show you. So this is the potential solution, and Walter, you brought this up, which is converting from an IRA or a traditional IRA to a Roth IRA. So the difference here with the Roth IRA is after-tax money that goes into a Roth account, a Roth qualified account. It can grow tax-deferred, and then it comes out tax-free. And it's tax-free forever. It's tax-free for your beneficiaries when you pass it on to them. Your growth is not taxed. Nothing is taxed inside that account. So yay, that's a great solution. We just take the money out, we move it over here, and we're all set, right? Except we have to pay tax on that little arrow there. That's where we deal with the IRS. But people can do this because you're basically saying, well, I'd like to get that silent partner out of my relationship here, and you move into that bucket. Now, you'll see there's a large disclosure down there. This is complicated. This isn't something where you just go in and say, all right, I went to this class, I'm going to go do it. There's a few things you need to know about how this works. First of all, as I said, there's tax-free distributions on the Roth conversion, assuming you follow something called the 5-year rule. So the 5-year rule is if you're under 59 and a half and you do a Roth conversion, you have to leave the money in there for at least 5 years before you touch it. Okay? If you're over 59 and a half, you can get immediate access to the funds. With a Roth, there's no required minimum distribution. The inheritance to your beneficiaries is tax-free. And written into the law is that they can't change the law. Okay?
On the Roths? On the Roth.
On the Roth. And really, if they change the benefits to the Roth is going to go away because nobody's going to put money into it at that point. There's one other small little part here, which there is a, and I won't go too far down the road here, but there is a part of the Social Security laws where the government uses something called provisional income brackets to determine how much of your Social Security benefit will be taxed. And if you earn this amount of money, this percent of your benefit will be taxed, and so on. It goes back and forth. Roth distributions, when you take money out of that account, do not count towards provisional income. So you can actually use those accounts to lower your Social Security tax. It's not on the screen, but it is part of how that works. So I'm going to give you a real example. This is a couple, and this happened back in 2017. And so now the timing doesn't really matter as much because we're in the new plan. But they came to a class in 2017, and they were right at the 15% bracket with their income. And they had money in the IRA, and they decided they wanted to convert all of it to the Roth. And so we went through and did some of that planning here. What we realized was that if they went ahead and did it in 2017, the cost of the conversion would be about 28%. Okay, so it would have equaled about $56,000 in tax at that point. If they just waited a few months, in 2018, it would be 22%. It would have saved them about $12,000, which they decided to do. Okay, so in their case, timing actually mattered in that. So is it a good idea to convert IRA dollars at less than 25%? I don't know. Maybe. Usually it is, okay, but everybody's a little bit different, and every situation's a little bit different. But I would say that most times, what we're seeing now, yes, it does make sense, at the very least, to look at it.
Doesn't it mean, if you're in a higher tax bracket, that's even gonna make you in a higher one, right?
Possibly, but there's that big
Yeah.
gap there with that 24% bracket that we're seeing is different. And that's, right now, that's in effect until 2026. The law is set to sunset in 2026. We don't know if they'll keep it permanent or what they'll do to change it. Now, what's neat about the IRS, they are a fantastic group. They have all sorts of little things inside the code that are tricky, that will come up and bite you. So I want to give you an example of that. These are the Medicare plans, and Medicare is means tested, which means, it's a joke, you're supposed to laugh, which means that it's based on your income is how much you pay with your premiums here. So, if you look over here, if you're married and you file a joint return and your income is $170,000 or less, each of you pay $134 per month for your Medicare. Now, if you come in and start doing one of these Roth conversions and you've got a big source of income for 1 year, it is going to push up your income. So our example of the couple that wanted to move $200,000, if they did that, plus their other income, it moves them down here. And now their premium per month is $348. That's about an extra $4,800 per year that they have to pay in Medicare. It's just for the year they do the conversion. It'll go back down once they're done with it. But this is the kind of stuff you have to know before you do this. I kind of look at this as a tax. It's like an additional tax, if you will. Then if you look at the drug program, that's another $50-$60 a month, so that's probably another roughly $1,200 a year. So you're looking at between the two an additional $6,000 in cost to do the Roth conversion. Which was another reason why when they did their actual conversion, they didn't do it all in a lump sum. They staggered it so that they could keep these costs down. We found a way to do it so that it made it the least expensive possible for them. Like I said, everyone's a little bit different in what that's going to look like. So why would anyone be willing to pay, in their case, $44,000 in taxes now? Now this I know is impossible to see. But all this is a little chart, and it's a program that I use called Strategic Income Planning. You can do this with Excel. In each of these little columns here are just different accounts for this client. And then over here is their income, Social Security, their income tax column, all of that. It just lays everything out for you. The point is, if you have a clear picture on why you're paying the $44,000 and what it's going to do in the future, say 20 years from now or 30 years from now, it might give you a little bit better understanding as to why you would consider doing that. Here's a zoomed in picture of what that looked like. So when that couple came in, we were able to calculate an effective tax rate after everything shook out with their CPA through the years would be somewhere around 10%. I have something called the 5-100 rule. There's all sorts of rules in financial planning. Everybody heard of the 5-100 rule? Very simple rule. The 5-100 rule simply says that any projection you're looking at, If you're looking at it further than 5 years out, it's 100% incorrect.
Uh-huh.
Because numbers change, right? But we're just trying to show them a trajectory of what they have and where they're going. Our CPA said, look, it's their effective rate, if they stay where they are, if the tax code pretty much stays where it is going to be somewhere around 10%. So over the years, if they, and they have good genes with longevity, if they live, they'll probably end up paying about $300,000, let's call it, in taxes over their retirement. If they come in and they do their Roth conversion and they do it over 2 years, in their case, they're going to pay about $116,000, but what happens is, now none of their sources of income are being taxed going forward. So the total bill is about $116,000 versus $306,000.
Do you know how much that income is, the most you can make, so before they start taxing you after 65?
The most income? Well, it's just like the different brackets that you have. I mean, it just depends on how much you're earning as to what you're going to get.
Well, you're saying that they don't earn any money.
Well, no, none of the sources they're drawing from are taxable.
Well, Social Security is taxable,
What happened here, if they're
under this certain
under the
amount.
provisional limit,
So that's what I was asking, what
Yep.
is that?
so 33,000 is the first bracket. And if your provisional income is $33,000, between 33 and 44,000, then 50% of your Social Security benefit is taxed.
Wow, okay, so.
And if it's
does
over
that matter?
44,000, 85% of your benefit's taxed. In
Does that
their
matter?
case, they're now below 33%,
That's
or
married,
33,000, and none of their Social Security is taxed.
that's married,
Correct.
all right, thank you.
Yep. So key consideration, everyone's different. I always say take advantage of complimentary second opinion to figure out where you are, where you need to go. We start, now we start tax planning for the future with people in their 40s. Because it's very complex and we can at least start down the correct road. And I always say the number one mistake people make is not understanding that investing during retirement is different than investing for retirement. I have a good friend in the industry who's about 10 years older than me, just as an illustration of this, and he told me one of the reasons he got into business was his grandfather had a lifelong goal that he wanted to retire and buy a little cottage up on the Upper Peninsula in Michigan and make it kind of a family heirloom and something that the whole family could have for generations to come. So he built an investment portfolio with dividend-paying stocks, and he saved up money and got to retirement in 1971, and he had enough money to do everything he wanted to. He had reached his goal. Went and bought the cottage, and my friend told me, he said about 5 or 6 years later, he remembered his parents coming to him and telling him, hey, we're going to the cottage for the last time. Yeah, Grandma and Grandpa have to sell it. And he said, well, what happened? They bought it, they paid for it, and that's theirs. Why do they have to sell it? And they said, well, they're out of money. You see, his grandfather had reached his goal to buy the cottage, but what he did was he built a portfolio that was built on growth and dividend-paying stocks. Does anybody remember what happened in the early to mid-1970s in the stock market, in the economy overall?
70s, no?
Inflation with the oil embargo. And what happened was his retirement was built on the same things that he had used while leading up, while he was still working, growth and dividend paying. And when the oil embargo hit, it cut those stocks' value in half and cut the dividends in half, and he didn't have enough money to live any longer. You remember earlier when I mentioned that our little chart, the thing that we changed with the first two on life and results, we changed life to goals, and we changed results to strategies. If his grandfather had looked when he retired at his goals and realized, hey, wait a minute, I reached this goal, what are my next goals? He might have changed his strategy and then ultimately the tools he was using for investing. But he didn't. He kept the goals exactly the same or never evaluated them, kept the strategy the same, and didn't realize he was off course.
So he probably should be annuitized some of his.
Something like that, or just diversified in some different way, right? So that everything wasn't in that sort of place where you couldn't recover from it. that's the basis of how you start to play. You can do this at home. Write down what your goals are, write down what your strategy might be to get there, and then figure out what tools you need to use it. And if those goals change, that means your strategy and your tools have to change too, because they're out of alignment. And that's the biggest, I said earlier, what's the number one mistake? This is it. People don't realize that investing during retirement is fundamentally different than investing for retirement. People make that mistake all the time. They think that what's worked for them in the past will work in the future. I got a guy, and I tell this story, I haven't told it in a while, but I tell this story, and we call him the tax man because he worked for the IRS. So he knows a lot about the tax code, and every time I have a question about the tax code, I call him. But he came to me, and he wanted me to help him with his retirement planning. And he came in the office, and this is why people remember this story. Came in the office, he said, Bill, I want you to do this, and I want you to do three things. I want you to protect my principal, I want you to give me some income, and if you can, I want you to grow my money a little bit. So people laugh when they come to the office sometimes, or they'll call me, or they'll, when they're scheduling a meeting, they'll say, I want what the tax man has, right? And one other thing the tax man told me was that he wanted, one other thing, I didn't put it on the screen, but he also wanted to be able to spend his money if he could, or if he wanted to. That's fair, right? He earned it. So a lot of people come in and they kind of want that sort of setup. So the first thing I did with the tax man is I ran an analysis on what he was currently doing using something called Morningstar. Has everybody heard of Morningstar? If you haven't heard of Morningstar, it's an analytical company in Chicago that'll analyze assets and your investments and tell you kind of what they're doing. And I know this is kind of hard to see, but it will tell you everything about what you have. It'll do it in an aggregate format, it'll do it with individual accounts, however you want to see it. But this is really important because people will usually come in with a standard of, I want to protect my money, I want some income, and I want to grow it a little bit. And then I'll look at what they're doing. And I usually realize right away that we're out of sequence a little bit. Let me show you, zoom in on something here. So this is what in our industry they would call a balanced portfolio. I tend to disagree that this is balanced, but I'll just explain to you what that means. Typically in our industry, a balanced portfolio is usually something made up of about 40% bonds, and about 60% stock or equities. That's what they say is a balanced portfolio. So I looked at this, and then I talked to the tax man and Mrs. Tax Man, and I said, look, when you guys put this together, what were you trying to do? How did you know to do this? And they said, oh, well, our advisor put us in this. I said, oh, let me ask you a different way. What were your goals? What were you trying to accomplish here? And they said, well, we just didn't want to take a lot of risk, and this is what we were advised to do, and we told them that we really don't want any more than about 10% possible loss at any given time. And I said, okay. I said, well, this report tells me something else. If I look at it, your aggregate tells me that where you are right now, at any one point over a 12-month period, you could be down 26%. Right? And they said, well, wait a minute, that's not what we wanted. I said, okay, well, that's what this portfolio did from March of 2008 to February of 2009. That was the worst year in this portfolio. Are you okay with that? And of course they said no. And I see that time and time and time again. People's portfolio, they think, is balanced, and it's out of step or out of sequence with where they really want to be. So I would say the first thing you might do is have some type of report like that run on what they're doing. So I usually look at other big investors that have the same goal as Mr. or Mrs. Taxman and try to explain a little bit more about this. This is the endowment fund for Harvard University. Okay? Now, the last reporting I had, this was 2015, but I don't think they've changed very much. This is where Harvard puts their money. Now, first of all, back up 1 second on one other thing here. If Mr. or Mrs. Taxman came and put their money with our firm and we made 37%, because it says their actual best year could be 37%. That's a lot of chance of up and down. But if they put their money with us and we were up 37% in 1 year, what do you think they would do? They'd be looking in the couch cushions to find more money to put it in whenever we put it in, right?
Yeah.
Conversely, if we came in the first year, they were down 26%, what are they going to do?
Take
gonna fire me, right? Because none of that is what they wanted. Back to Harvard here. Harvard puts about 16–17% in domestic equities. Remember, the tax man and his wife had 40% in equities. Fixed income was 9%, international equities was about 19%, alternative strategies is more than half of the portfolio in what they're doing. Now, if I'm managing the Harvard Endowment Fund and I earn 37%, they're probably going to be pretty happy with me, right? And if I lose 26%, what's the Harvard Endowment Trust going to do to me? They're going to fire me. So that's why the Harvard Endowment people don't invest like that. They invest in things that are very steady. So here are some of the alternatives that they invest in. Real estate, commodities, life insurance, fixed index annuities, covered calls, structured notes, reinsurance, enhanced yields, etc. Now some of those things you've probably heard of, some of them you haven't. I can tell you that about 15 to 20 years ago, virtually none of those things, or most of those things, were things that we could not invest in. But the investment world has changed, and we can now invest in most of these things. We can actually build portfolios that look a lot more like this and are a lot more in line with the risk levels that people are trying to seek. All right, so the simple question on that is, how does your portfolio stack up? If you don't know, you probably need to have it reviewed. And are you taking on more risk than you realize? I would say that 99 out of 100 people are taking on a lot more risk than they realize. And the time that they figure it out is when the market actually contracts on them. Isn't it a good time to get a complimentary second opinion? That's what we do. So the recap on this, 401ks, IRAs, they often create tax problems during retirement. The new tax code offers a window of opportunity to at least examine where you are and figure out if it can help you. And then the big thing too is many investors are unknowingly taking on more risk than they should. And going back to where we started, I think it comes back to these three areas here. Your goals, your life, what's important to you, your strategy and results, and the tools that you're using to get there. Again, 9 times out of 10, those things are out of sequence with each other, which means people ultimately don't end up where they think they're going to on their retirement journey. Okay, so what we need to do is turn the lights on, but brace yourselves. It is shocking when we turn, just turn one of them on if you would. There you go. All right, now your eyes will adjust. So, what I do with my classes, if you're interested in coming in and talking more about the tax code, any of the other things that we talked about tonight, I always offer a complimentary consultation. Inside your packet here is a response form, and I do need you to at least fill out the top of this. Right here. Because I need to be able to myself tell the IRS or prove to the IRS that I put this class on so our expenses can be written off for it. The other part in the middle there, it says please list your concerns. And down at the bottom, what I would suggest you do is pick out your first and second possibilities. Even if you don't know your calendar, I would suggest you write them down and pick a couple of times, because you can always come back and change them later. But here's what I know to be true. If people don't put their information down now, or they say, well, I'll call you, that sort of thing, what happens is life is busy and life gets in the way and we will never meet. And so if anything you've heard tonight is of interest to you, and frankly, in the financial sense, I don't know many other things that are much more important than that, you should pick a time to come in and talk a little bit more specifically about what we're doing on there. We will usually call just to say thanks for coming, but we usually don't chase people down in what we're doing. We're busy with the other classes that we have, so we won't bother you with that. But if you are interested to come in, what we do is we will sit and talk for 45 minutes. You get to ask me your questions, I get to ask you my questions, and we'll decide if another meeting is necessary. And if it's not, you'll learn a lot of good information, and we'll wish you well, and off you go. So we'd love to see you guys in there if it would help you. And thank you guys for coming out. That's what I have for tonight. I hope it was worthwhile braving the cold weather to come out, and I hope you learned something. Did you learn something?
Yeah.
1 or 2 or 3 things maybe?
Yeah.
Good. Well, thank you guys for coming out. I appreciate it.
Thank you.
I have a question.
Yep.
What is the single? You gave me the married.
Yeah.
33,000.
If you will, I printed them and left them on the printer. Right here, I'll show it to you in the.
Alright.
It's It's in here, and I realized it wasn't in the packet, and I tried to print them out and left them on the printer. So now, here, the 24% bracket is up to 157,000 for single filers.
For single filers.
Yeah.
Yeah, and now this is important, by the way, too, because if you have your own IRA and, or your spouse has an IRA and they leave it to you, you are now a single filer, which is the worst tax brackets out of the two. Okay? So keep that part in mind too. That's another disadvantage to the IRAs, is the beneficiary that you leave them to is now in a higher bracket overall, or a high. If you double 157,000, you're not up to the 339. You're already squeezed a little bit more in that particular bracket than the married jointly people are.
So what do you recommend then, if you're saying no IRAs to reduce your taxes now while you're working? What do you recommend?
I don't necessarily say no IRAs. What I would say is there is a proper balance in what you need to have in your pre-tax, your after-tax, and your tax-free to get the maximum benefit out of the IRS's tax code. And that takes a little bit more work to figure out what that balance is.
So who do you ask to balance it out? Your accountant?
No, they won't know how to do that. That's what we do. Your accountant can look at things on an annual basis. They know how to minimize your taxes on an annual basis. There are very few accountants who will look down the road at the long-term basis for that. We have a CPA in our office that we work with to make that happen.
Thank you.
Thank you all for coming out.